What is going on, guys? Welcome into another podcast here, podcast number 5 with the growth series. We're going to be talking about a bunch of really important concepts today, which will be definitely useful for your trading journey. We once again have Peter and Ivan in the house today. You guys want to say hi?
Buddy.
And we are going to be talking about definitely let's do a market wrap of what happened last week, and then maybe talking to the main points that we want to get through today. Just for people who are listening into the second podcast of the series, thank you very much for taking your time out and giving us a listen. We hope that you find some of this useful. Share it with your friends, family, or even your pet dog if you want. And so really interesting week this past week. I think a lot of price action mayhem, kind of expected during the OPEX week. We kind of already saw definitely the whipsaw, but never did I imagine that we would rally so hard at the end of the week. Once again, another combination of things leading to, massive short squeeze and some short covering. What do you guys see in terms of the price action this past week?
I mean, for me, the standout for last week was volatility, right? Like we had a significant gap down on Monday, gap up on Monday, another significant gap on Tuesday. And then we slid, Wednesday and Thursday, and then remade all of that ground in the short squeeze on Friday. So for me, like price action, you asked me about price action. It's all just like super big range, super big volatility right now.
Yeah, that's been really good for day trading too, right? I think if you're a day trader, this is a paradise.
If you've got well-defined levels and the wherewithal to take your trades when they hit, you can make a lot of money.
Yeah. What about you, Ivan?
Yeah, same. Super volatile week. I'm feeling, MM strapping people, both ways, up and down. And definitely what happened Friday, was not expecting it, to be such a huge squeeze. I believe, Friday they took us up to a really key pivot level. And so we have to wait until Monday to see what happens.
Yeah, definitely. I think this past week all has been very choppy, but at the same time has given us a really interesting way to look at this bear market. More importantly, I think there are a couple of things to mention here. In terms of macro situation, I don't think much has changed. In fact, this cuts out the work for the Fed. Now, and also on Friday, the Wall Street Journal posted an article hinting towards a possible Fed rate hike. That gave the market that jitters that it needed to scramble for that upside exposure. Mainly, I think this is what caused some of the squeeze on Friday. It was a lot of market players that were caught with their pants down looking for exposure to the upside, then bulls jumping on, saying, hey, wait a minute, there's something here. The price action just continued upward for the rest of the session with very minimal pullbacks. We had a mini pullback, but it was, faded away very quickly by bulls. And we saw the breadth of the market remain relatively flat, I would say. Even if you look at IWM, it did buy up, but once again, as Ivan said, to a key point, right up to that 172, 173 level. And obviously, we could see a reversal back again. It's just a matter of what the price action is going to do on Monday. On top of that, we definitely saw interesting moves on the VIX. But once again, the VIX is not really super bullish until we get below 28.50 or so. And the bond market has been a dumpster fire, right? So the bond market is definitely signaling a bit more pain ahead. And short-term bondholders are definitely commanding that higher yield because of the uncertainty in current times. It's an interesting time to be a trader right now because I think this past week, many people were sitting on their hands. And then on Friday, everybody just got fed up and jumped on the bandwagon, right? But also, we had the dollar make a surprising move down, but once again, within the trend, still hasn't broken into a downtrend, still remaining an uptrend yet. We did make lower highs and get rejected twice at around 113.97 or 113.90 around that level. And we've been seeing since then a lot of pressure to the dollar to the downside. Also, not to mention, on Friday, we had a big Bank of Japan, Central Bank of Japan, BOJ, made a big intervention in terms of Forex policy. So that also caused a lot of people to dump the dollar. But it's honestly, I think, a temporary move because so far, the Japanese yen has been in a lot of trouble this year. So there's been a lot of pressure factors that caused the rally on Friday, but still none of those things have been fundamental changes. They've been mainly technical changes, like, mechanical things, which have been really interesting. What do you guys think?
Yeah, I think for me, the biggest thing that hit my macro radar was the Wall Street Journal rumor about the Fed. I think right now, like the Fed policy it's one of the pillars of the bear market right now. And so any dovish adjustment to that is going to bring the appetite for risk back, probably disproportionately at first too, because everybody's feeling pretty beaten up at this point.
I think as Peter stated, whatever, when the Feds come out and just mention anything about cutting rates or anything like that, everybody's gonna jump on the train to go bullish. I think on Friday, besides, I think it was a lot of short covering, with all the options because of OPEX. And that's, the Fed or the article was just fuel for the short covering as well to, go up so high.
Yeah, so I think there's an interesting dynamic from the mechanical point here. So first things first, pessimistic sentiment had peaked in the past 2 weeks. We've had the amount of bearish news headlines and the amount of, bearish overall sentiment has been absolutely nerve-wracking this past, 2 weeks or so. And then at the same time, you had the put-to-call ratios, which I have mentioned, were the highest since COVID, the 2020 COVID crash. In fact, they're higher than that period. And so it did make sense for market makers to skew the price action towards the upside in order to really evaporate a lot of that gamma away. So market dealers have been spending a lot of their time keeping the levels above 3,700 or so. And they've been really actively doing that this past week. So they ended the week higher at 3761, which was well above those call strikes that they've been trying to keep above it. And all in all, I think this next week is going to set the tone for a lot of different things. You have almost 40 or 50% more of the S&P 500 reporting earnings this coming week. You have a lot of large mega caps reporting earnings. And this is really going to set the tone for how, performances of the market. Of course, we're not expecting lackluster, super blockbuster performance from many of these stocks. But then again, remember, as I mentioned on the previous podcast, the same thing happened last quarter. We had a very pessimistic view of the market. We saw, I think a lot of these stocks are going to underperform for earnings. And then these stocks, they actually surprised to the upside. And we had a huge bear market rally that lasted for almost a month, or less than a month, maybe about 3 weeks. And that, led to a lot of price action squeezing to the upside as well. So let's talk about that for a second. The elephant in the room, bear market rallies, right? This is really an interesting topic right now because in a bear market, we have seen more than once these huge squeezes in the past. And just to give you guys a little bit of statistics here, and this some of this credit goes to Michael Burry for putting out this information. He did mention that 12 of the top 20 Nasdaq one-day rallies happened during a 78% drop from the 2000 tops. So 9 of the top S&P one-day rallies happened from the 86% drop from the 1929 top. So having said that, we've seen bear market rallies of more than 10% in the past bear markets, like after 2000, the dot-com crash. There have been almost 16 bear market rallies of more than 10%. And also, the Dow has seen more than 10 bear market rallies of more than 10% during the same time. And so I think that theme continues here. It's an interesting theme, especially because in a bear market, it's very difficult for everything to go down constantly, just like how in a bull market, it's very difficult for things to go up consistently. And so whenever you see that huge impulse wave downward, there's always going to be that pullback and that correction for sentiment to brood and kind of see, are we really walking in the right direction here? And so these rips are definitely more expected, and they're going to become more violent with the VIX being higher. So the question becomes, do you buy the dip in this kind of in a rally, right? Because I know the main thing that people think about in this kind of a situation is, how do we play this? As a day trader, your answer is pretty simple. You have your pivot points, you're trading between them. But as an investor, becomes a very painful time, because you can buy the dip, it rallies a little bit, and then, you get a terrible entry and it keeps going down again. And then you do the same thing. And, after a certain point, you run out of dry powder, and then you're like, oh man, I've just expended all my capital. And now at this point, I'm not really sure what to do. So what do you guys think? What would be your strategy to buy the dip here? How do you treat this as an investor or as a trader?
So, the answer that I think I would give to somebody who asked me, who maybe wasn't like an active market participant or didn't necessarily follow markets in a sophisticated fashion. I mean, I think dollar cost averaging is kind of that's the conservative strategy. That's what conservative money managers do. That's how, a conservative portfolio is dealt with, right? Because they don't even try to time the bottom. But another strategy that I've heard people take with a little more nuance, like for somebody maybe with that's a little more in tune, is they can watch something like a moving average crossover, right? Which is what a lot of e-advisors, like digital advisors are based on. They follow moving averages, and so you can wait, for example, like the 821, 8 EMA and 21 EMA. You can wait for a crossover to occur and say, okay, I'm not going to try to time the bottom, but there is a signal that the trend may be reversing here, so I'm going to average in at this point. You can use it to define the inflection points for dollar cost averaging, and maybe maximize your efficiency a little bit with that. And then, so yeah, I guess that's the strategy I would take, I think.
I have to agree with Pete. As we know, there is no way for anybody to time where the bottom is going to be. So probably using the moving average is the best option to add to long-term portfolio. As of the way it's been happening for the last 2 weeks, the bouncing of the 200 SMA on the weekly chart, that would be a good, that was a good add-on point for the long-term portfolios. We could go down more, but that was a good point to add.
Yeah, these are really good points. Obviously, I do think that's honestly the right way to do things. You get in tranches at very specific points. You say, okay, this is where I'm going to add one tranche. This is where I'm going to add the next tranche. You use the moving averages as a good guide. However, you have to always remember moving averages are lagging indicators, and so they're not a reflection of future price action. And so it's a good way to see, okay, where has price action been in the past? So that is definitely a good strategy. You can use, the 200 moving average, or, a longer term moving average on a much bigger time frame, like the weekly or even the daily. And, you can keep adding whenever you break through specific key levels. And dollar cost averaging is definitely going to be the answer here, because you don't want to time the market. You just want to make a timed investment at the same time every month, or whichever frequency you choose. It could be a month, it could be 2 months, it could be 3 months, whatever you want, and keep buying at that same time. It doesn't matter where the price is, because at the end of the day, you will get an average price over a long period of time, and that's just going to be good for your retirement portfolio. So I think for long-term investors, this market doesn't really change your method. It's only for active traders where you really feel the pain of this market, and especially if you're an options trader, you can't get the timing right. That's when your theta is going to evaporate all those contracts, and gamma is going to really squeeze them. But also the psychology or the psychological torture of this market has been very relentless in this bear market squeezes, and that's one of the things too. are one of the topics that we want to really talk about today. It's the psychology of trading. I think it's really interesting because in a time like this, you can see a lot of whipsawing of sentiment. One day people could be bullish and next day people are bearish. The market whipsaws back and forth between fear and greed in a very orderly fashion at the moment. And also another thing, which really adds fuel to the fire is, the overconfidence bias, where, there's a tendency to hold pretty much a false or misleading assessment of your, position. And one of the things that kills traders in this market is their ego, right? And like, this is my view. My view is the best view. It's the right view. They feel so overconfident about it that it becomes their bias. And this can be really, really dangerous during this time of the market because with volatility so high, there's nothing to be confident about because you could easily play both sides of the situation, even if you are still bearish. Which, to make it very clear, I am still a bear in a bear market until proven otherwise, right? I've always said that when even in the previous podcast I mentioned, you remain a bear in a bear market until the market proves and by sending you price action higher and higher. And then you can, say, okay, I'm done. And you can switch your sentiment around. So there's no point to be overconfident though, because even when you get a huge short squeeze like we did on Friday, you have to remain objective the following week. It's just one of those things where you have a time when the psychological part of the market is really taxing because this is the time where traders are more likely to cut their profits early and then let their losers bleed even longer, and as I've mentioned before, this is that loss aversion theory or the utility of money, which really, really screws you. For those of you that don't know and listening to podcasts, loss aversion or the utility of money is a very interesting concept because think about it this way. Let's say I gave you $50 and it was gifted to you. Would you really find much utility for that versus let's say you were walking down the street and you lost $50 from your pocket? You would be really angry because you lost that $50. But the fact that you were given $50, you'd probably be more like, okay, it's $50. I'll just use it towards something. So the utility of money when you receive it is always lower than when you lose it. That utility loses very, very quickly. It's one of the very researched phenomenons in behavioral finance, which is a topic obviously that I'm very interested in. And it's also boils down to how people react in markets. So I find these two things really, really important right now in the current situation because it's going to keep traders in this constant loop. What do you guys think?
Yeah. Bias. Bias. I mean, it's easy to talk about. It's harder to manage, right? Especially in the moment. The psychological torture of a bear market is that if you have long-term investments, they're drawn down. And so even if you're rational about, if you're an active trader, you can be rational about the trend. You can be rational about what the market's doing. You can be rational about identifying when the market is irrational. You still have your nest egg drawn down, and that's going to place a burden on your mind. Even if you're trading successfully, you've got that weight of drawdown present. And so you're losing on that half of your portfolio. And then when you get on the wrong side of a short squeeze or a bear market rally that you weren't prepared for, the sense of loss is compounded. And then it aggravates the instinct for loss aversion. And it just, you can get so messed up, by the emotional attachment to your money that's being pulled in two different directions, neither of which is the way you want it to go, that you just start making really bad trading decisions. It's very dangerous, and like you were saying, kind of the inverse of all of that is, you think you have a great read, you think you've overcome your bias. And the minute you think you've overcome your bias, right, like you're in the, you're neck deep in an overconfidence bias. And you decide, well, I'm going to put a lot of conviction on this trade because, this thing's going down. Like, look at the last however many weeks, like we're in a deep sell off. Like this next leg's going to be X number of points. You decide you're going to load heavy on it. And then then you get something like Friday's squeeze, and all of a sudden you're 80 or 100 points on the wrong side of a trade that you loaded too big because, you know, your ego blinded you to the possibility of being wrong. And when you were wrong, you didn't have the good sense to get out of the way. You couldn't admit you were wrong. You wanted to hold on. You couldn't, you know, your ego doesn't want to admit that you made a mistake or that you were wrong. And so all of a sudden, you know, you take a big loss and it evaporates psychological capital. And, you know, I mean, you can lose financial capital and retrade it. You can't retrade your psychological capital in the same way. Like if you get rocked in your head and it messes you up, the only cure is time. And depending on the experience you've had, there are some people who suffer catastrophic losses that they never come back from, because it just destroys their ability to trade. It destroys their ability to engage with the market. You know, I was listening to a podcast once with some high-level institutional traders, like professional traders, guys that traded millions and millions and millions of dollars. And this guy, he was talking about, I think it was the 08 crash. He was saying there are guys who during 08 sustained such shock to their nervous system, their neurological system, that they had to get different careers. They could not come back to trading. And, you know, he said part of that was like a lot, you know, there were some of these guys, they wanted to put on hero trades to save the book because, you know, they realized, oh crap, like this is bad. And I'm going to be the guy that saves it. I mean, so there's your overconfidence bias. They put on these massive trades, and then these trades went against them. The market moved against their trades, and these people, I mean, it's not just that they lost big; it's that they hurt themselves physically. They hurt themselves physically and psychologically to the point where they had to get different careers because they could no longer touch volatility, because it hurt them too bad. It's like PTSD. Anyway, that's.
I agree. The toughest, as we know, the toughest part of this game is the mental capacity that you put into it. Some days, your bias takes a hold of you, and even so, the play can go your way, but it can change in 2 minutes, and your whole bias and your, I had the perfect strategy. Yeah, I had the perfect, I called the play I wanted to play, but, I hold it for 15 extra minutes or half an hour or whatever. And there you go. You're toasted. You're done. So you could, stay in a play and play it perfectly for 2-3 weeks, and your bias could be right, but it could change real quick. And, for people like me, and I know there's plenty other new day traders out there, that daily changing from one side to the other, it really affects you mentally, to try to stay focused. Where do you need to be? And, I know it's easier to say than do it, but, to wake up thinking on, I'm not going to have any bias today. And, let's see where the market is going to go. It's still in the back of your mind is that like personally me, I'm short term, and long term, and, bearish. So it stays in the back of your mind that, you think that the market is going to continue going down. And here we go. Friday comes, and in 15-20 minutes, it just completely flip on you, and that's it. You could be toasted. Like personally, like me, on Friday, I decided to stay out. I didn't do anything until towards the end of the day, because of my, my short and long term is, I'm still bearish. So I waited towards the end of the day, and, I played, what I think is where we're going to head, so.
That's That's definitely true. You guys brought up some really great points. I love hearing all of it. And just for our listeners, I want to also put in some really interesting feelers here. Here are some ways to know if you suffer from loss aversion. Okay, and if this sounds like you, I'm also going to tell you how you avoid these things, because I think there should be some benefit and for listening to this podcast. So let me give you guys the lowdown. Right, here's 2 ways that you know that you're suffering from loss aversion. Well, the first way is if you see a stock that's running up and you take your profits very early, and you realize, you tell yourself, I would rather realize a small gain than to have, a big loss. You constantly tell yourself that, then you suffer from loss aversion, right? If your analysis indicates that the stock should be held for a longer period of time for a larger profit, but then you saw the green at like 10% or 5%, and you're like, okay, I'm going to take it here. But you know that the trend is still intact. You're still moving in an uptrend. You suffer from loss aversion, all right? Another one is the flip side, which is you tell yourself that a loss is not a loss until you take it. That's another indication that you suffer from loss aversion, because both of these things, they work hand in hand. And obviously, if you have this problem, the best way to avoid it is to be consciously aware, first of all, that you suffer from this problem. Okay. So when you're taking a trade, remember that you have to tell yourself that, hey, I am prone to making this mistake. Keep it at the back of your head. Let's say you're in a bullish position, and you feel like, okay, we're going to keep going higher. You can always opt to take a opposite trade. So you can take a hedge to your existing bullish position, where your net is still going to be a gain, whichever way the market moves. And in this market, it's very possible to do this since volatility is so high. So maybe you're taking a bullish position right at a key pivot, and you decide, okay, I'm going to take both a call and a put. At the pivot, whichever one breaks, you hold on to that position longer, right? That's one of ways that you can solve this problem. Another way is if you're an investor, obviously, and you're not trading options, or you're not a day trader, you're just a regular old investor, choose companies that have really, really strong fundamentals, right? And this will give you the conviction, because remember, as Graham says, or Benjamin Graham, one of the most, pretty much Buffett's guru, right? In the short term, the market's going to be a voting machine. In the long term, the market's a weighing machine. And so you have to realize what companies are really, really good in terms of performance and what are trash. Having said that, some fun facts or some key things, like, for example, just 1 year ago, or during the 2021 rally in the markets, we had stocks like Square, Snow, Uber, Shopify trading at really, really high forward multiples. Fast forward exactly 1.5 years, and these stocks are down close to 50 to 60% year to date. Their market caps have evaporated by almost 3/4, and their EBITDA are almost down triple digits in terms of millions, which is really, really huge, right? You would think, oh man, these companies were purported to do so well. In fact, out of the bunch, Uber was one of the better performing stocks, because they managed to pivot their business model a little bit. And you still have stocks like Rivian or Lucid that are also not doing as bad comparably, but still pretty bad in terms of performance. So that's definitely some things that you have to keep in your mind when you're trading. Keep that overconfidence bias, that loss aversion in check. And then the last one is your confirmation bias. And confirmation bias is an interesting one, because there are a few things that I actually wanted to bring to this podcast today for you guys to listen in with. It's, first thing would be the fact that you are very, very likely to overrank something in your line of trading. Like, whenever you're trading, you're likely to say, you know what, I think my performance is better than most other people, and therefore I'm going to succeed. This ego really drives you to your demise. Like, to think that way. It's not, obviously, we're not saying you got to think of yourself like a person who's not good, but remember that you have to remain humble in a market like this. It's a very difficult market to trade in. You have to always be willing to learn. And the reality is that most people think of themselves as better than the average person in trading. And this can cause really big problems, because it makes you take on a lot more risk than you should. Majority of the time, people get thrown out of trades or stopped out unnecessarily because of the risk that they take on, and it's an anchored problem from overranking their own system. The second one is the illusion of control, which is pretty much they feel like they have control over the situation when they don't, or they feel like institutions have control over the situation when institutions don't. This is one of perhaps the biggest problems in day traders in the current market. They feel like MMs are against them. They really, really feel victimized. I think, if anything, you would have seen this more prevalent during the GameStop saga. GameStop, AMC, remember the meme stock era? There was a huge problem with this. People were really feeling victimized by market makers or hedge funds. And they started to rally against them. Like, oh man, it's them. It's Wall Street versus us. Dude, Wall Street doesn't know who you are. Trading is a completely anonymous profession. You remain anonymous. Nobody knows who you are. Not only that, if you think that the real person that the MMs are against, it's you're seriously very misguided, because the problem with big players is they're not afraid of retail traders. They make up such a small percentage of your market. Big players are afraid of whales. People like bigger banks, investment banks that can really move wholesale capital. That's what they're really afraid of. It's how am I going to get sniped by a bigger player out there? And retail traders, they're kind of just floating on the underbelly of this, like maybe like a smaller fish, and a whale comes around and swipes up that smaller fish. But you, being the retail trader, that's a small little anchovy right below that smaller fish, you become the collateral damage between these two parties. That's what usually is the situation. But retail traders always overemphasize the fact that it's them versus the market maker, when actually that's not the case. And so that illusion of control really demolishes you sometimes. You make it feel like every single move is victimized. Like, oh man, I'm a victim. Yeah, go ahead.
There were something that I wanted to add to what I was saying before is, for new traders is try to keep the noise, away from you. I'm saying it because it has happened to me in the past 2 or 3 weeks. All the Twitter and all the how do you call them, the gurus in Twitter and the Elliott waves and this and that, and try to stay away from that, because that can hurt you really bad. That's what I wanted to say.
Yeah, definitely. I agree. Then you have that, what's that problem? Pretty much decision paralysis. That's the other thing, right? Too much overstimulation of information and then not being able to decide. So you pretty much come to a state where you have just too much of stuff going on. And then you're like, okay, now I don't even know where the market's going to be. This causes two things. One, you don't make the move that you intended to. You leave money on the table. Number two, you're so scared that you take the opposing trade and then that goes bad. So it sends you in both directions. It's really, really not, a good thing. And then another aspect of behavioral finance that people suffer from sometimes is the timing optimism. This is another interesting one. It also boils into overconfidence a little bit, right? It's where people pretty much overestimate how quickly they can do work, and they underestimate how long it takes for that specific job to get done, especially for a complicated task like trading, right? And pretty much it takes investors a very long time for investments to pay off. And they always say, oh man, okay, I want this trade to go my way within the next 1 week. And so they overestimate the time that's needed. And then sometimes they underestimate that same time and they take on too much time, and then they, face that brunt as well. So timing optimism is probably another big cause of why people fail so much. It's trying to time the market to the perfect T. Everybody wants to catch the entire fish from tail to head without realizing that sometimes the most tasty, juicy part is the meat right in the middle. You don't really need to catch the bottom or the top. You just want a small move, especially as a day trader, of the most tastiest part, especially if you're looking for that maximum gain on options contracts. That's when the peak gamma acceleration is anyway. And so, that timing is really, really important sometimes, and you have to get it right over many, many years of training. And yeah, so these are really important things. Another one from the overconfidence bias is the desirability effect, where people really become, desirable of their outcome. It's kind of like wishful thinking, where if you see bunny ears, you try to aim where the bunny ears are and you think there's a rabbit there, when actually there is no bunny ears. This is an interesting one because I believe we've spoken about this like many, many months ago, Peter, where, we were talking about this YouTube video of a guy who was wanting to remain anonymous and trading the markets, and his job was to paint candlesticks. This is a really interesting one we spoke about, I think, many, many months ago. And the wishful thinking or the overconfidence bias plays right into this one. It's people see a head and shoulders, so they want the market to drop. People see an inverse head and shoulders, they want the market to rally. People see Mickey Mouse formation. Obviously, I'm kidding. There's no Mickey Mouse formation, but they see a formation that they think is going to happen. They get ahead of it, thinking that it's going to go and play out the way that they want to. And then wham, the market makes a completely counterintuitive move, taking out every single, respective position that was in its week. And this week we saw some of that too. The Monday gap down and then a huge buy up and then the continued rally into the end of the week. That was a very, very good example of how the wishful thinking really got over analyzed this past week. And now, right when everything's about to flip the other way, and people are about to be greedy and take the upside positions, there's also another risk here that we slam the other way. So it's truly one of the most, difficult times to be trading in, because there is no directional play here. Everything's moving sideways. And if you try to get overly exuberant, you're going to be punished. What do you guys think?
Yeah, I mean, that's a good point. We're moving sideways, but we're moving sideways with such volatility that you really can't take anything for granted. Like if you trade in anticipation of the next move rather than trade on confirmation of the current move, you might get hurt really badly. What this has taught me is maybe this is a little bit of loss aversion on my part, but it's better to miss an opportunity waiting for confirmation than it is to capitalize an opportunity with no confirmation and get hit hard. I'm looking at the chart for the S&P right now, and my analysis from today, I was looking at everything. I've got a short-term bullish bias, kind of like I'm seeing a probability for a rally. I've got levels where I think that rally will inflect. Either it'll reach it and surpass it, or it'll reach it and reject it. But my bias is up. But I'm also like, if I'm seeing that, then maybe a lot of other people are seeing that, and it could very well be too good to be true, right? It's like, oh, I see an inverse head and shoulders on the 4 hour and blah blah blah. But anyway,
So you see that, everybody's seeing that, but then what if the real pain trade is the opposing of seeing that? You know what I mean? It's difficult sometimes. Like the friend of my enemy is what's that saying? The enemy of my friend is my enemy, or the enemy of my friend is my friend. You know what I mean? There's always that double whammy. It's like, okay, since everybody's seeing the same trade, is there a possibility that this goes the opposite direction? But then wait a minute, it could go that direction because everybody's seeing that direction. You know what I mean? It's difficult. For me, I like to use the price action as the most apparent indicator, because price action builds into a lot of the current, news and information that we're being presented. But yes, I do agree that in the short term, there may be a bias run for the upside. But once again, as you said, if that rally does go underway, then there could be a pain trade there too.
Yeah. Sort of what I've distilled, the whole point of analysis, maybe this sounds obvious, but like you get it in layers, and your appreciation for these facts becomes deeper over time, the more time you spend doing it and making a skill out of it, is that all of this analysis that you do, you can set levels, you can set indicators, you can do whatever your process is. All of it comes down to formulating an intelligent bias, right? The market's binary. It goes up or it goes down, right? Like even when it's going sideways, it moves up and it moves down. Price doesn't do anything else. It increases and it decreases, right? So you want to formulate as a bias that is substantiated, right? And then you want to set parameters around that bias where you control risk, right? Like your only task is to formulate an intelligent bias and then set key levels where you manage risk if you are wrong, right? So come to an idea of what happens if you're right, and come to boundaries for what happens when you're wrong. And when those boundaries are crossed, like, be ruthless in respecting them. Just like, no, I was wrong. It means nothing to be wrong. Your ego, if your ego requires to be right, maybe trading's a bad pursuit for you, because even the best are wrong a lot, right? It's just when you're wrong, only lose a little bit when you're wrong. And so, the pain trade, I guess the point of that is be prepared to flip your bias and take the other trade. Like, it's not just, maybe that's where the real mastery comes in, is like, okay, you realize you're wrong, but you're in such control of your own ego and your own discipline that when you are wrong, you can, without hesitation, flip your trade and take the trade that you didn't think was going to be the way to go, and then go with it and make money. And, so that's,
I agree. I think that's a good way to look at it. And that's one of the frameworks for what I operate on as well. It's, let's say, for example, at the end of the week. So just to give you guys some information, obviously, I took shorts right at the top right there, right pretty much before we closed. And for me, that's a key level for me to take shorts at, because even if we get higher from there, I can easily get out of my bias. Let's say I think, okay, next on Monday or Tuesday, the market rips higher. I'm going to see exactly how far above this trade that I take. Let's say we get above 38.10. And remember, there's always going to be some spillover, right? Exuberance always pushes the market into one direction, and we're likely to see those levels broken. But how we close above those levels will give us the important information that we seek. And so for me, the main thing that I'll be watching for this week is, do we close and hold above 3,800? How often can we do that? And how often are we going to stay above 37-ish, where that levels are really holding? Are we going to hold above those levels, et cetera, et cetera? And that's going to be the main thing for me. If we do hold above those levels, I simply switch my bias and I go bullish. But if we start to reject the upper levels and we see a huge rejection, then that gives me that, confidence to add to my short position. In the meantime, I've not over allocated my risk, so I'm able to keep myself nimble out of those positions. And remember that always the market's never going to breathe out in one direction indefinitely. Yes, the market can get very bullish on a sentiment change, or if the Fed announces something, but in a normal market where, there is no news, or, there is a very defined outcome in terms of range, then you can easily manage that risk at a key pivot point, which is where we are right now. So I like to take that framework, and I do agree with you on that. What do you think, Ivan? What is your plan for this coming week? What are you going to be looking at? You want to give our listeners some key levels, or what is your, short-term bias?
Basically the whole week, SPX 500 was in a bull flag, and even so, we broke the bull flag on Friday. We had really good volume in the morning, but when it was time to break the bull flag, I feel like the volume wasn't there. It was almost dying. So it wasn't a breakout, with power, volume, power, strong power and volume. So I'm still, in the same bias as you. I'm still in the, bearish side. I think 38.10 is a key level. I did the same as you did. I took the puts towards the end of the day. And if we get above 38.10, 38, 40, 38.50, then, you have a better risk and reward, and then you can cut the trade and be done with it. 38.10 on my chart was the, when we bounced, the hard bounce that we had last week, that was the 50%. 38.10 actually is about the 38.2 fib, the retrace from the low of COVID. So to me, that's a good level. if we go above, let it go up, let it come back, let it retest it, and then I'll switch my bias and I'll go bullish. But that's the plan for Monday. See what happens. If we break 38.10 with good volume, and we retest it, and they give us the confirmation, then I cut my puts, and then switch and go with calls, because I think if we can break the 38.10, we can easily get to 3900.
I agree. I think that's a good way to look at it. And I want to give myself obviously some room above 38.10, because around 38.20 you have that little peak up into September 22. There was a little peak over there. So there is a dual zone that will be approaching around 38.35, 38.37. And so that region is really going to be the test level for this week for re-entering bearish shorts if we get that exuberance. Right now, it seems like, because pessimism is at all-time peak, it takes very little for this market to find a reason to go bullish. And I think that's going to be the way that I'll be looking at it heading into this week, and be taking opportunities as, we go along. But I think that kind of wraps up what we have for this podcast this week, and we'll be back with another one next week. If you enjoy listening to podcasts, and we're going to upload this now. We're on Spotify and YouTube. I'll be adding more platforms in the days to come. Hopefully, we're trying to also get on Apple. And when we do that, we'll definitely be updating you guys. But drop a comment below on what you want us to possibly talk about. If you have anything that you want us to analyze, or simply a topic that you think is interesting that you want us to talk about, we love hearing your feedback. We want to definitely engage with all of our listeners. And we truly appreciate you guys taking our time out to be here, listen to us, and keep yourselves nimble in this market. And we'll see you on the next one. So take care and peace out. Bye-bye.